Welcome to the Value Investor TV podcast. My name is Becco and my partner Hari.
Hello.
Thanks everyone for joining us. Really glad to have all of you today. We are going to talk about coronavirus that's sweeping the world and putting a lot of people in misery. And of course, as value investors, what we are interested in is how this virus is impacting investment and the market. So in this episode, we will talk about exactly that. Before we do that, Hari, can you give us a quick disclaimer?
Yeah, this is the Value Investor TV podcast. This is the podcast that teaches you how to be a value investor and the concepts behind value investing. We are not your financial advisor, nor do we know your specific financial situation. So if you are in need of those services, please contact a specific advisor for that.
Awesome. All right, Hari. So maybe I'll give you a quick, maybe a quick color on what this looks like on the ground. I'm not. My family isn't from China, but they live pretty close to China. So my family lives in South Korea, and obviously, because it is so close, they are on the ground experiencing something like what's going on in China. So maybe I'll start with that. So my parents and my friends and family have been telling me that obviously you've seen it on the news that number of masks available for people to purchase. People aren't able to get kind of resources they need, and there's a lot of panic in Asia, and that's kind of spreading all across the world. This coronavirus thing started sometime in December, and then got spread all over the world, starting with countries in Asia, Singapore, Philippines, Vietnam, Korea, Japan. What's interesting is the rate at which this virus spreads. This is one of those viruses that it is deadly, but not as deadly as some other viruses. But the rate at which this coronavirus spreads is pretty at a really breakneck speed. So it has obviously gotten attention of health officials all around the world, including WHO. Hopefully, none of your family has been affected by this, Hari.
No, I mean, as far as I know, nobody in my extended family has anything related to it. I still have quite a few family members in India, but as far as I know, India doesn't have anything. But I think for those of you who don't know, I'm a practicing physician. And almost every hospital, clinic, and so on has now protocols for quarantining patients who are coming back from China, saying that, and, that was initially what we were doing in January, and now it's at the level of travel bans to and from China. And if you are coming back from China because you're a U.S. citizen, you're being quarantined for 14 days, which is the incubation period for the virus. So, I mean, the interesting thing about this is as viruses go, it's like a very bad flu in terms of morbidity and mortality. But the people who are dying from it generally have what's called comorbid conditions, which is they have some other disease like diabetes or heart failure, or they've had other medical problems. And for the vast majority of the people who get it, it's it's a very bad cold, pneumonia / flu-like symptoms, and then but the thing that is making it so bad is that it is very, very infectious. And I think initially China is want to do, and as communist countries do, they kind of hide the truth, right? And so no one really knew how bad this was. They thought it wasn't that infectious. And it is spread very quickly. and what that has led is, a very delayed kind of reaction from the Chinese government because they wanted to downplay its significance, led to this thing spreading to a much, further region than just the Wuhan region of province of China. And when we start talking about why that's so important, we will. But I think the main takeaway from this kind of discussion is that, as value investors, you don't really know when things like this can happen, right? In 2001 or 2002, China had a similar outbreak called SARS, which had very similar kind of infectivity, but it was more self-limited. And at the time, China was a much smaller economy, right? I think China has grown significantly since then, and its place on the world stage has also grown in significance. And so, in an interconnected world with everybody trading and everybody relying, China is now the second largest economy. So initially, the impact was probably going, people thought, oh, it's just an outbreak, whatever, it's not going to be a big deal. But now that China is shutting down factories, preventing businesses from, even opening, I think it's having a bigger impact than people, originally thought. And so, we'll finish up with the medical aspects of this, and then we'll actually talk about the economic impacts of this. This normally viruses like the flu and other things are transmitted by human-to-human contact, so they are trying to isolate people from other folks, or if you've been in contact with people who've been sick, they're trying to isolate those folks from other individuals because of the infectious nature of this. But the interesting thing to me is that this virus is a beta coronavirus. It is it was not previously found in humans that we know of, so they suspect that a bat, it has a 96% overlap with known bat coronaviruses, and so we suspect that this is coming from, either somebody got infected from respiratory droplets from a bat, or they ate a bat and got it that way. So
there's also interesting kind of intermediary that came up also in some of the articles where it was bat that gave it to some other animal, and then that other animal gave it to human. Yeah,
so a pangolin is the thought to be the intermediary. So a pangolin, for those of you who don't know, it kind of looks like a armadillo. So how that happened, I have no idea. But
what's also kind of interesting about these viruses that originates from bat is that, like, SARS was speculative to be kind of have the similar pathway to humans, starting with bat and then going to some kind of like cat. I don't know exactly what type of animal that was, but through that, and then the Middle Eastern Middle East syndrome, something like that happened.
MERS.
And that also came from bat and then to camel and then to human. It's interesting how like bat is the originator for a lot of these viruses. It's a host of a lot of the viruses, but it gets transferred over via another vehicle.
I'm not going to say what you should do, but just medically speaking, just don't eat a bat, please. Like, that's, first of all, it's gross, and second of all, it's really gross. So, and third, you're probably going to cause the next outbreak of God only knows what. So,
it's interesting. Like the bats are known to be this host of so many different viruses. It's just it's crazy how physiologically that works. I read a couple of articles about that, how bats are host of a lot of viruses, and yet they're able to survive. They've built up this immune system to be able to kind of coexist with viruses, with a whole host of viruses.
Yeah, as far as I know, it doesn't even infect the bat. It's just kind of lingers there. So
yeah,
I mean, it's gross, right? Like, if you've ever seen a bat, I love me some bats. Like, they eat mosquitoes here in Texas. Fantastic. Just don't eat them. That's just, that ain't right. So stick with delicious animals like cows and pork. And
by the way, I just had to mention Hari is from Texas, so he's biased on that. He's a beef man.
Yeah, I am. Because beef is delicious. So
Okay, so that's kind of the background of coronavirus. It's infecting the world. We're recording right now this episode on the 16th of February. It is still the fever around coronavirus is still at its it's still climbing to new heights every day. Numbers coming out of China is growing. Just a couple days ago, when they redefined how you calculate number of people who are infected by coronavirus, it jumped significantly, materially. And so it is still going up. We're still experiencing it. And so, as value investors, we have to kind of think about how, I guess the question for this episode is, how do you think about things like this, where you don't expect, obviously, who would have expected coronavirus to occur around this time? No one. I mean, maybe a few here and there, but, as value investors, how do you think about that? And when, as something like this occurs, how do you think about your investment portfolio?
yeah.
So Hari, yeah, go ahead.
Well, I think the answer to that is not every company is going to be affected the same, right? So companies with very large moats that are well run, that are not financially dependent on, that are not financially dependent on the economy running perfectly, right? Are going to be the best stocks in these, when things like this hit. And the reason for that is when you have a very large moat, you can kind of weather the storm of, a company, your supply chain being disrupted by, a market in China that is not shipping, for example, in Wuhan, they ship car parts to a lot of the world. A lot of the factories that are being affected now are, heavy in manufacturing and in industrial. And a lot of these businesses are heavily dependent on, this supply chain. So, in a long-term fashion, companies can shift their supply chain to other places, but in the short term, it's very hard for them to do so, right? Because you're expecting a 90 days out, how much are you going to build? How much are you going to need? You probably don't stock, 90 days worth of parts, right? What you do is you get on-demand shipments, and then you kind of know how much you're going to build in every, quarter or every season. And, China is the largest importer of raw materials, right? Because they turn those raw materials into things that then get put into, finished goods, right? Sometimes they finished them in China, sometimes they're finished in the US or other places, right? But, they are converting a lot of things into things that get used in the products that we use every day. And so I think there's a lot of companies that are in the automotive industry and so on that are going to be affected. And, interestingly, a lot of this quarantine is actually going to have a positive impact for businesses that are in China that are purely online, right? If you think about a company that is, if you're stuck at home, you can't leave the house, and, you're under a quarantine, what are you going to do? Well, most people will spend their time, on entertainment, and that entertainment will probably be things that are online services, movies, TVs, etc. So, are there beneficial, companies that will benefit from this, quote unquote, systemic shock, right? And I think there are. There's plenty of internet-based companies and things like that in China too.
Yeah. Yeah, I think it's interesting that you point that out because, for every crisis, let's call them, every crisis that happens, there's always winners and losers in it for everything. And so I think it's important to think about these sort of, highly unpredictable events to, from value investing standpoint, like to think about it from the perspective of, okay, who can be the winners, who can be the losers? And obviously a lot of heavy manufacturing, automotive industry, like you mentioned, Hari, perhaps a lot of agriculture industry that exists around the area, things like that. Industries like that would be affected, but other industries, like you mentioned, entertainment industry, online, digital content industry, could be a boon for this. Although this is, like you said, it's a systemic shock across the entire world, but at the same time, this is an acute systemic shock,
Yep.
where it's a it's not a fundamental paradigm shifting kind of. For example, example that comes to mind is, for example, like tariff war with a little bit longer time horizon with U.S. kind of taking a different stance. It's more of a systemic. We're kind of using medical term, but more chronic kind of situation where this is still systemic but more acute, and so there might be an arbitrage where you can play here in a relatively shorter timeline.
Yeah, and I mean, it's safe to say 2.5 months ago, nobody knew or expected this to come out, right? And so I think a lot of companies that are heavily dependent on heavy manufacturing, that is coming out of Wuhan are, may not have alternatives if they have, sole suppliers. And I think that, that kind of also indicates, you should be paying attention very closely to conference calls and press releases now from companies that are in these industries to see what their expectation is for this. Because, China has been saying for prior to this that they were going to grow about 6% annualized their GDP. And now when you shut down businesses for weeks at a time, growth is not going to be, you should be expecting negative growth here, right? And I think that's what I would expect to see out of China for the quarter. But remember, there are some businesses that may be growing and other businesses that are hurting as a result of this. So it may be shifting where growth is occurring, but as a whole, the country may be shrinking economically, right? Mm-hmm. But I think the main takeaway from this is a short-term problem, right? It is not going to be, as far as we know, as of in February 2020, this is not an ongoing thing. Generally, virus outbreaks like this have a limited, lifespan as the medicine gets better, as they figure out how to control and prevent travel and things like that. The spread kind of is self-limited, and then hopefully, a vaccine gets generated, from all of this that prevents the spread even further. But I found it interesting too that, people who don't understand what is going on are using this because China had just had their Lunar New Year. There were people saying that in Chinatowns in San Francisco and in Manhattan, or I'm sorry, in New York, that people are not going to the Chinatown for the celebration for fear of coronavirus outbreaks, right? So to be clear, there is no coronavirus in any of these places, but people hear China, they hear coronavirus, and then they're associating that with the Chinatown in their local city. So it's almost silly to even think of it that way, but it's affecting the economy in ways that are unexpected, right? If we were just talking about this in a theoretical format, I don't think I would have said, well, I think local Chinatowns in your, that have nothing to do with Wuhan are being affected by this. So, there are ripple effects that are going to be felt across Europe, the U.S., because they're so heavily dependent on China. But I think the other thing is that, as far as I know, there are no confirmed cases in places like Vietnam and Thailand, or if they are, they're very limited. These may be opportunities for these countries to start kind of expanding their manufacturing capability, and people may start shifting their sole source supplier from China to other places.
Yeah, exactly. I just want to add one more comment on what you pointed out in terms of kind of this hyped fear about coronavirus and Chinatowns and Chinese tourists. I was in Europe. I was in France for a little while, about 2 weeks, and there's obviously, in Europe, especially in France, in Paris, it is I think 30% of their GDP is from tourism, and a big part of tourism is Chinese tourists coming to Paris and buying luxurious goods and things like that. And obviously with coronavirus, the number of tourists went down. But even with that, there is a kind of built-in fear, towards a Chinese tourist. And as you mentioned, there's ripple effects, societal ripple effects, even outside of just economic ripple effects taking place around this coronavirus.
Yeah, and I think to your point there on around tourism, the real companies that may be affected that are U.S. based are definitely airline companies. That are going to lose travel between China, travel between Southeast Asia, due to these flights being canceled because of the WHO and countries preventing travel. So, I find it interesting to see if this continues. We have the Olympics set for, I believe, August or September. Is that going to affect the Olympics? Is that going to be able to, even happen because of this? If the coronavirus hasn't been controlled by then, which I think it will be, but who knows at this point. So there's a lot of things that are, that depending on how long this goes, this may have a fairly big impact. And the other thing that we haven't really discussed around this is there are a lot of companies in China that have a lot of debt, and obviously they're not making any money right now. Is the Chinese government going to secure these debts because of the thing, or could we see a systemic unraveling of the world economy because of that, right? Because of these companies going under. So, it has not. This is not. Wouldn't be the first time that this has happened in terms of bank failures causing big ripple effects because of what Warren Buffett called the weapons of financial mass destruction, credit default swaps and things like that. I don't know enough about these, things to see how it would affect them, but there's definitely some risks associated with the ripple going out beyond China.
Yeah, just make a couple comments on that. I think, obviously in China, there's a lot of, as you mentioned, there's a big debt problem in China right now. I think the last decade, there was a big promise of super hyper growth, not just people, outside of China looking in, but also people within China expecting this hyper growth to happen. You saw, obviously the remnant of that is all these ghost towns that exist, kind of symbolizes the once great hope that it was. And now it's, empty ghost towns. You see a lot of these projects that are debt financed, and now companies are sitting on this, massive pile of debt with no way to pay it off. I think, this is a systemic problem in China right now. And as you mentioned, this is a risk if you have an economic slowdown. How do you finance? How do you pay for these debts? How do you take care of these people? I think from a societal perspective, I think that's an important question. Another comment I want to make is numbers coming out of China is something that I think all of us should be a little bit, we have to be a little bit more, a little bit more cautious around, especially I think in terms of economic data that's coming out of the Communist Party, the government authorities.
Yep.
As much as I would like to believe in these data, obviously that's not to say that economic data coming out of Western countries, Western democracies like U.S. or UK are perfectly pristine. There are obviously obvious faults there, but the degree to which kind of manipulation happens around these numbers is, there's no equivalent, to Western democracies, I think, when you're talking about numbers coming out of Chinese government. So I think that's another point I wanted to make, just that we have to be careful about these numbers. We can't take them at face value.
Yeah, I think the big risk here is that the Communist Party in China, tries to control the messaging to its own people, to the rest of the world. And, what they have been saying for the last couple of years is, everything is good, we're doing well, everything's great. And I think what we've seen with the trade war, which, we only saw the first phase one of that deal signed, is, I think the U.S. is strong-arming the Chinese government, and it is actually having an impact. Right now, what is the overall impact? I don't know yet. But I do think that and it's hard to tell because, like Becca was saying, they're not telling us all of the facts, right? But I do think what we're seeing is that China, for the most part, has had very low cost of labor, and then they started manipulating their currency to reduce, to essentially keep that cost of labor low relative to the rest of the world's currency, right? And that's kind of how, because their cost of living has gone up faster than the rest of the world, they should not be a heavy manufacturing country as heavily as they are, right? Had they not been manipulating their own currency, right? Mm-hmm. So, I mean, regardless of what you think about Donald Trump, he is right in that regard, in that you are effectively reducing their cost of labor artificially by manipulating their currency, right? And so the end result of this is manufacturing in China has stayed there when their natural progression would have been to more knowledge-based work than heavy
to phase it out.
Yeah, to slowly phase it out. And so
yeah, that's interesting. The market force. So let me just, if I can quickly recap what you're saying is, the market forces, had the Chinese government let the course play out, let this play out its course, the market forces would have phased the entire country slowly out of manufacturing. But they came into the system and artificially injected the company with the cheap labor, and therefore the market forces isn't acting as it should.
Right. And so what you're seeing also is countries, the countries have, the companies have a lot of debt on the books. And in China, a lot of it is short-term debt, right? They don't really keep long-term debt. So you short-term meaning in the financial sense, has to be paid off within a year. So things like this for a country that's already on sort of rocky ground, right? If you're a manufacturing country, right, which China is because they have billions of 1.3 billion people, they want heavy labor-based industries, right? And they have, and because they're a totalitarian government, they're forcing labor, people to be in the labor force, right? And so that's kind of what we're seeing right now. Is it's hard to trust anything that comes out of this country. Now, does that mean that they're going to collapse economically? I doubt it, right? I mean, but there's going to be pain, right? And that pain may have an impact on the rest of the world as they are unable to pay for, service their own debt. And then companies that are, generally companies that, fall apart when that happens are companies that are already on the margin, right? So companies like Alibaba and Tencent and the ones you've probably heard of are fine, right? Because they're, the bellwethers, they're the large moat companies. They have a very large market cap. But it's the ones that are in the smaller, agricultural businesses, the smaller industries, some of these companies that are based in Wuhan that are, manufacturing things, they may get wiped out because they don't have the, the debt servicing capability anymore, especially when they've lost 2 or 3 weeks of production. And then, having to ramp all of that back up is not the same as if it were just, the next business day, right? When things are running smoothly. You've got to service it, maintain it, all of those things. And, who knows how much of your labor force will actually be available if they're under the quarantine and things like that. So,
I think those are all, salient points, Ari. And I think it kind of goes to, I think it's reflected on, to a degree, obviously, as value investors, we want to look at individual companies. But if you look at overall companies that are listed here in the U.S. Or dual listed, you can see the level of discount that is being applied to some of these countries. And I know some people in the investing community call them China discounts. I know something very similar exists in Korean companies where you have the perpetual, albeit small, threat of North Korea. So the companies in Korea are generally relatively trading at lower PE overall. So something kind of like that is happening with Chinese companies for those mid to lower tier companies. Like big tier companies, Alibaba, I think they're fine as they are, as you mentioned. But you're seeing that discount being applied in the marketplace for companies in that tier for Chinese companies.
Yeah, generally anything that has a household name is going to be fine. It's the companies you've never heard of that are going to be the ones that are affected, right? And that's true of almost anything, right? Even in the U.S., if there was a shock, there may be one or two big companies that fail, but they were probably teetering to begin with. Mm-hmm. But for the most part, companies with high margins can weather the storm by, either lowering the price or things like that. Companies that are on razor-thin margins can't afford much loss in sales. And if they're also heavily indebted, they get wiped out, right? That's just kind of how it works. I mean, you've heard me talk about Toys R Us all the time, right? Toys R Us was a company that was paying a lot in interest. It was a very profitable business, but because of interest, that they had taken out because the company that bought them was a private equity group, put in a bunch of money to buy the business by using their loans, and then the debt was never paid off. The servicing of that debt became too expensive, and then it wiped out all of their profit. And then eventually they just went under because they could no longer even invest in their own stores, right? Yeah. This is a very common thing for a lot of companies that have been around for a long time, is that because the debt level that they have put on, for whatever reason, some CEO has decided that he wants to, take this old staid business and try and grow it. It eventually comes back to the debt level itself is all their revenue is paying for, right? All of your profit is wiped out because of the interest that they have to pay, let alone the the principal on the debt itself.
Yeah.
Right? And when that happens, that wipes out a company pretty quickly.
Yeah, I mean, I think things like maybe a couple points here. You all obviously in one of the checklists, on the checklist items, for people who have been listening to our podcast, that we go through a checklist every time we analyze a company, and one of the things that we have to look at is what is their debt level and how financeable is it? Like, is it manageable? Is it a point where it's manageable? Not every debt is bad. Some debt, if you use it wisely at the right time, it's perfectly fine. But obviously, you don't want to be in a situation like Toys R Us where they're so overwhelmed by the debt requirement. And so obviously, that's one of the first things that you have to look at in terms of analyzing companies. But another thing that I want to point out is things like coronavirus. No one really knew that this was going to happen, right? No one really knew something like this was going to happen. This is sort of like something out of the unknown door that's coming out and really biting us. And so how do you kind of think about these sort of unknown situations that no one really predicted, and it's now having a massive impact, at least short-term wise, it is having a massive impact. How do you think about that from value investor perspective, Ari?
So I don't. I buy companies that are way undervalued, or I buy companies that have a large moat, and that's it. I don't have to worry about the unknown unknowns, because if they have a large moat, they're protected, right? Their business model will protect them because there aren't many competitors, right? And if they're very undervalued, I want to ensure that they don't have a whole lot of debt that could wipe them out, right? So every investment that you make, you're going through that checklist specifically for that reason, right? Is that you want to first eliminate any businesses that have any potential for being wiped out by any single event, regardless of what that event is, right? You want companies that it would take 3, 4, 5, 6 events to knock them out, right? Because those, when you start adding big events, it doesn't really become likely that they'll happen all in sequence, right? Companies generally have time to recover from those things, right? But debt is really where companies get wiped out. It's not because their earnings decline. It's not because of that. It's always because they have too much debt, and then somebody has to call it in, right? Mm-hmm. And so what I would say is the unknown unknowns, you can't really know them. But what you can do is say, because by definition, you can't know them. But what you can do is know the businesses well enough to know that they're strong enough to weather downturns, right?
Mhm.
And expect, is this business recession proof, right? So, I mean, think of a company like Dollar General, right? They're a neighborhood market, that you can buy household goods, you can buy some food items, you can buy various things. It's kind of a get in, get out store, right? And they're generally cheaper than what you would do at a grocery store, maybe with lower quality items, right? They do very well even in a recession because the consumer who is squeezed financially will go after those businesses, to buy more. So they do well when other businesses may struggle.
Yeah.
So whereas you look at luxury item goods, those are the first things that people will give up, right, in a recession, is because they don't have money for, by definition, a luxury item is not something you need, right? So I think it's important to really pay attention, one, to what is the business, what is its moat, and what is the valuation that business has, because most businesses will take a haircut in a recession, right? And if they're really good businesses, then it's an opportunity for you to buy more and hold on to it. And in other cases, it may be an opportunity to to shift your portfolio into things that are better, that have better moats than what you already own.
Yeah. I think this obviously comes back to the thing that we always champion in this episode, in this podcast, which is you always have to go through a checklist and you always have to understand your business before anything else, right? So understanding the moat, understanding the business, what protects it from competition, what protects it from catastrophic single event like this, and also really looking at the debt level, like you mentioned, Hari. So those two things, among other things that we look at in the checklist, are a way to prevent the unknown unknowns, because, as you mentioned, by definition, unknown unknowns is unknowable until it happens.
Yep.
And so, in preparation for the unknown unknowns, the best thing you can do is to really understand your business and be prepared for the unknown unknowns, because by doing that, you are preparing for the unknown unknowns.
Yep.
Yeah. Okay, great. So the coronavirus, I think it's an interesting topic. It is, we're recording here in still February 2020. Still a number of people who are infected, number of people who are dying from this is still going up. Numbers coming out of China has gone up. Other countries are affected by it. Now with the end of Lunar New Year, people are going back to work. There's been some discussions about some auto part manufacturers in Wuhan. They're debating whether or not to start the operation or not. There are a lot of discussions happening right now. It'll be interesting it is interesting to follow what's going on and think about it from the perspective of value investing. Anything to add from your side, Hari, before we close out?
Nope, I don't think so.
Okay, great. Well, thank you guys again for joining us in this episode. Really appreciate you joining. I know this is our second episode in the new year. We have really good episodes coming out. Prepared for you guys in the next coming weeks. So please stay engaged, stay tuned. And if you guys would like a copy of the checklist that we talked about in this episode, please email us at info@valueinvestor.org. info@valueinvestor.org. We'd be happy to give you a copy of that checklist. We also have a Slack channel. It's an online community where you can join and ask us questions, ask each other questions. It's a community of our listeners. So if you would like to be part of that community, please email us also at info@valueinvestor.org. We'd be happy to send over an invite. Great. Thank you so much, guys, for tuning in. And we'll see you guys in the next episode. Thanks, guys.
Thank you.